Your stock spreadsheet is lying to you. It's a beautiful, orderly grid of numbers, a landscape of earnings per share, price-to-earnings ratios, and debt-to-equity figures. It feels safe, it feels rational, it feels like the entire story. And that is the most expensive lie in modern investing. It's a lie that has cost retail investors and so-called professionals trillions of dollars over the decades. It's the lie that a company is nothing more than the sum of its financial statements. Warren Buffett, the man who built a $600 billion empire from a struggling textile mill, knows the truth. He knows that the most powerful asset a company possesses never appears on a balance sheet. It's not a factory, a patent, or a pile of cash. It is an invisible force, an unseen architecture that dictates every decision, every interaction, and ultimately, every single dollar of profit. It's the company's culture. And for the next 2 hours, we are going to teach you how to see it, how to measure it, and how to use it to achieve the kind of portfolio growth you currently believe is reserved for the insiders, the elites, and the legends of Omaha. This isn't a lesson in soft feel-good metrics. This is a masterclass in hard-nosed financial analysis that goes beyond the numbers. This is the qualitative analysis that separates the amateur stock-picking enthusiast from the professional wealth management strategist. The costly mistake that 99% of investors make is believing that culture is a byproduct of success. The truth, the secret that has been a cornerstone of Buffett's long-term investing philosophy, is that a world-class culture is the cause of enduring success. It is the single greatest durable competitive advantage a company can build, because unlike a new technology or a clever marketing campaign, it cannot be easily copied. It must be grown, nurtured, and defended over decades. By the end of this journey, you will no longer look at a stock ticker the same way. You will have acquired a new layer of vision, a new tool for your investment research that will allow you to identify the businesses that are truly built to last, the ones that innovate from the inside out, and generate extraordinary capital gains for those wise enough to look past the spreadsheet. This is the key to beating the market. This is the final promise. Chapter 1: The Foundation of Trust. Let's begin in Omaha, Nebraska in the year 1983. A 53-year-old Warren Buffett is about to make one of the most significant investments of his career. But there will be no army of lawyers, no teams of accountants performing months of due diligence, no exhaustive financial analysis of audited statements. There will only be a handshake. The company he is buying is the Nebraska Furniture Mart, a local institution with staggering sales figures, a veritable retail juggernaut built from nothing. The founder and matriarch of this empire is Rose Blumkin, a tiny, indomitable Russian immigrant who is, at this time, 90 years old. To understand the investment, you must first understand the woman known to everyone as Mrs. B. She had fled Russia in 1917, escaping persecution with her husband and settling in America. She couldn't speak a word of English. She arrived with nothing but a fierce determination. In 1937, with a loan of just $500, she started a tiny furniture store in the basement of her husband's pawn shop. Her business philosophy was brutally simple and profoundly effective: sell cheap and tell the truth. She worked 7 days a week, from open to close. Her pricing was so aggressive that established competitors tried to run her out of business, pressuring carpet and furniture manufacturers to boycott her. When they refused to sell to her, she would travel to other cities, buy from other retailers, and sell their products in her store for even less than those retailers were charging. She was relentless. Her word was her bond, and her customers knew it. If she told you a rug was high quality, it was. If she promised a price, it was the best you would find anywhere. She built a bond of absolute trust with her community. By the early 1980s, Nebraska Furniture Mart was doing over $100 million in annual sales, an astronomical figure for a single-location furniture store in Omaha. It was the largest and most profitable store of its kind in the nation, and it was all built on the culture Mrs. B had forged. It was a culture of fanatical frugality, obsessive customer service, and absolute integrity. Employees weren't just workers, they were family, many of them having worked there for decades. They shared Mrs. B's work ethic and her commitment to the customer. This wasn't something you could see on a spreadsheet. It was the lifeblood of the organization. Warren Buffett had been a customer for years. He'd watched this phenomenon unfold. He saw something far more valuable than inventory and real estate. He saw a moat built of trust. So he approached Mrs. B. He wanted to buy her business. He asked her for a price. She thought for a moment and named a figure, $60 million. Buffett didn't haggle. He didn't ask to see audited financials, because there were none. The company's accounting was notoriously informal. He didn't demand warranties or representations about the state of the business. He simply asked her one question: would you be willing to compete with us? Her answer was a firm no. That was all he needed. The deal was sealed on a single-page document, a testament to the trust between two business titans. Buffett was buying the culture. He was investing in the unwavering integrity of Mrs. B and the family and employees she had trained. He knew that the financials were just a trailing indicator of the real asset, a high-trust organization that was a money-printing machine. He paid roughly $55 million for 90% of the business, leaving the family with the remaining 10% and, crucially, with full operational control. This transaction is a cornerstone of Buffett's secret philosophy, a perfect lesson for any retail investor or seasoned entrepreneur on the true nature of value. The numbers told him what the business stream Farca was. The culture told him what it would continue to be. The science behind Buffett's handshake deal with Mrs. B is one of the most powerful and overlooked forces in economics and psychology. It's the concept often called the speed of trust. In any human system, from a two-person partnership to a multinational corporation, trust is not a soft emotional luxury. It is a hard economic driver. High trust creates speed and reduces cost. Low trust creates friction and increases cost. Every contract, every compliance department, every multi-level approval process, every single piece of corporate bureaucracy exists for one reason: a lack of trust. These are, in financial terms, transaction costs. They are the tax paid by organizations that don't have the cultural asset of implicit faith in their people. Let's dissect this on a cerebral level. Our brains are fundamentally wired to deal with what psychologists call the principal-agent problem. In any situation where one person, the principal, like a CEO or shareholder, delegates work to another, the agent, like an employee, there's a potential conflict. The agent might shirk their duties, act in their own self-interest, or cut corners because their incentives aren't perfectly aligned with the principal's. The traditional corporate solution is monitoring, performance reviews, surveillance, complex rules, and punitive measures. But these solutions are incredibly expensive. They require layers of middle management, HR departments, and legal teams. They consume time, energy, and capital that could be used for innovation or customer service. More insidiously, they create a culture of fear and CYA, cover your assets, where employees focus more on not getting blamed than on doing great work. A high-trust culture, like the one Mrs. B built, effectively solves the principal-agent problem without the associated costs. It operates on the powerful psychological principle of reciprocity. When an employer demonstrates profound trust in an employee, by giving them autonomy, believing in their integrity, and treating them like a valued partner, the employee feels a deep-seated psychological obligation to reciprocate that trust. They work harder not because they are being watched, but because they feel a sense of ownership and personal responsibility. They give their discretionary effort, the energy and creativity that goes beyond the job description, freely. This isn't just a theory, it's visible in neuroscience. Acts of trust and cooperation trigger the release of oxytocin in the brain, a neurochemical that reinforces social bonds and promotes further trustworthy behavior. A high-trust organization is essentially creating a virtuous cycle, a feedback loop of positive brain chemistry that fuels productivity and loyalty. Buffett didn't need to audit Mrs. B's books because he was auditing her character. He knew that a leader who operated with such profound integrity would have infused that same code into the very DNA of her company. creating a self-policing, highly motivated workforce that was far more efficient than any competitor. This psychological insight is a key component of a successful portfolio strategy, allowing an investor to identify businesses that are internally streamlined for success. So how do you, as an investor conducting your own investment research from your home office, apply this principle? How do you measure the invisible asset of trust? You must become a corporate detective, looking for the clues that spreadsheets hide. This is your blueprint, a practical mental model for assessing the trust level within a potential investment. Step 1. Analyze the language of leadership. Read the last 10 years of the CEO's annual shareholder letters. Is the language clear, direct, and honest? Does the CEO openly admit mistakes and take responsibility? Or is the letter filled with corporate jargon, buzzwords, and blame shifting? A leader who writes with clarity and humility, like Buffett himself, is often fostering a culture of transparency. A CEO who obfuscates and uses passive language is likely presiding over a culture of fear. This is the foundation of your qualitative analysis. Step 2. Scrutinize employee data. Go to websites like Glassdoor and read employee reviews. Don't just look at the star rating. Read the detailed comments. Are the complaints about low pay, or are they about a toxic culture, micromanagement, and a lack of respect? The latter are far more dangerous red flags. Look for trends. Is the company culture consistently praised for empowering its people? Furthermore, investigate employee tenure. You can often find this data in corporate social responsibility reports or infer it from LinkedIn data. A company with high employee turnover is a leaking bucket of talent and institutional knowledge. It's a massive hidden cost. Conversely, a company where people build entire careers is likely a high-trust environment where human capital is compounding, just like financial capital. Look for companies that promote from within. A high percentage of senior leaders who started in entry-level positions is a powerful sign that the company invests in and trusts its own people. Step 3. Examine the customer relationship. Trust between a company and its employees is almost always reflected in the trust between the company and its customers. Read customer reviews. Is the company known for honoring its warranties, for having no questions asked return policies, for providing excellent support long after the sale? Companies like LL Bean or Nordstrom build empires on this kind of trust. They empower their frontline employees to make decisions in the customer's favor, a clear signal of high internal trust that translates directly into external loyalty. Step 4. Evaluate the governance structure. Is the board of directors filled with independent voices, or is it a collection of the CEO's friends? Is executive compensation tied to simple, long-term metrics like return on invested capital? Or is it a complex web of bonuses tied to short-term stock price movements that encourage manipulation? A simple, transparent governance and compensation structure is a hallmark of a leadership team that trusts its own long-term strategy and wants to align itself with long-term shareholders. By following this 4-step process, you move beyond the simplistic financial analysis that traps most retail investors. You begin to build a mosaic, a detailed picture of the internal workings of the company. You start to see the business not as a machine for generating numbers, but as a human system for creating value. This is the CEO mindset that every successful investor must adopt. Now let's turn our attention to the dark side, the antithesis of the Nebraska Furniture Mart. This is the path of the 99%, the story of companies that look spectacular on paper right before they implode, destroyed from within by a culture of fear and mistrust. The cautionary tale for our generation is Wells Fargo and its phantom account scandal that erupted in 2016. For years, Wells Fargo was the darling of the banking world. It had fortress-like financials, a stellar reputation, and the backing of Warren Buffett himself as a major shareholder. On the surface, it looked like a perfect investment. But beneath that surface, a toxic culture was festering. The leadership had instituted a high-pressure sales culture centered around an initiative called GR8, the goal of which was to have every customer use 8 different Wells Fargo products. This wasn't a suggestion, it was a command. branch managers were relentlessly pressured to meet impossible sales quotas. Employees who failed to meet these quotas were humiliated, demoted, or fired. This created an environment of pure terror. The psychological principle at play here is known as perverse incentives, combined with a total lack of psychological safety. When survival depends on hitting a metric, people will hit the metric, even if it means breaking the law. The result was that thousands of employees, in a desperate attempt to keep their jobs, secretly opened millions of unauthorized bank and credit card accounts in their customers' names. They would forge signatures, create fake email addresses, and transfer funds without permission. This was not the work of a few rogue employees. It was a systemic breakdown of ethics driven directly by the culture. For a time, the numbers looked fantastic. The cross-sell metrics that Wall Street analysts loved were soaring. But it was a house of cards built on deceit. When the scandal broke, the financial and reputational damage was catastrophic. The company was fined billions of dollars. The CEO was forced to resign in disgrace. Customers fled in droves. And the stock price, once a beacon of stability, plummeted, erasing tens of billions of dollars in shareholder value. Buffett himself would later admit that the mistake was not selling sooner, acknowledging that he had underestimated the rot in the culture. The Wells Fargo story is the ultimate proof that culture isn't a soft issue. A culture of mistrust is a multi-billion-dollar liability hiding in plain sight. It is a cancer that will eventually metastasize and destroy even the strongest-looking balance sheet. The financial connection between a high-trust culture and a company's performance is not abstract. It is direct, quantifiable, and profound. Let's translate the principles we've discussed into the language of income statements and balance sheets, the language that dictates capital gains and long-term portfolio growth. First, consider the expense side of the income statement. A high-trust culture directly lowers operating costs. Employee turnover is a perfect example. The cost to replace a single employee, including recruitment, hiring, and training, can range from 50% to 200% of their annual salary. A company with 10,000 employees and a 20% turnover rate is losing 2,000 employees a year. If the average replacement cost is a conservative $50,000, that's a $100 million annual drain on pre-tax profit. A high-trust company with a 5% turnover rate spends only $25 million. That $75 million difference flows directly to the bottom line, boosting earnings per share year after year. This isn't a one-time gain, it's a permanent structural advantage. Second, think about revenue. A high-trust culture empowers employees to provide superior customer service, which leads to higher customer retention. Acquiring a new customer can cost 5 to 25 times more than retaining an existing one. Companies with loyal long-term customers have a more predictable and profitable revenue stream. They spend less on marketing and advertising because their best marketing is word of mouth from a happy customer base. This translates into higher net profit margins, a key metric in any rigorous stock analysis. Third, look at the balance sheet. A high-trust organization is less likely to face catastrophic legal and regulatory liabilities. The billions of dollars in fines paid by Wells Fargo were a direct hit to shareholder equity. Companies with strong ethical cultures sleep better at night, and so do their investors. They are not sitting on ticking time bombs of litigation risk. This stability is a hidden asset, a form of insurance against value destruction. Finally, and most importantly, consider the return on invested capital, ROIC, the ultimate measure of a company's financial performance. In a high-trust environment, capital is allocated more efficiently. Projects get approved faster because there are fewer layers of bureaucratic review. Teams collaborate more effectively, leading to faster innovation and product development. Great ideas aren't killed by political infighting. The entire organization moves with a speed and agility that low-trust bureaucratic competitors can't match. This means that every dollar invested in the business, whether in a new factory, a new software platform, or a new marketing campaign, generates a higher return. Over time, this superior ROIC is the engine that compounds shareholder wealth and is the defining characteristic of companies that truly succeed in beating the market over the long run. When you learn to see culture, you are learning to see the machine that generates the numbers, not just the numbers themselves. Chapter 2: The Customer Obsession Moat. In 1972, Warren Buffett and his partner Charlie Munger made a decision that would forever change their approach to investing. It wasn't a massive industrial company or a dominant bank. It was a small, regional candy company based in California called See's Candies. On paper, the deal looked mediocre. Berkshire Hathaway paid $25 million for a company earning about $4 million pre-tax. It wasn't a statistical bargain, the kind of cigar-butt investment that Buffett had built his early career on. See's owned very few fixed assets. Its value wasn't in its factories or its delivery trucks. Its value was in the minds of its customers. See's Candies had been founded in 1921 by Mary See. Her son, Charles, insisted that they use only the finest and freshest ingredients, and that her recipes be followed to the letter. Their stores were designed to be immaculately clean and welcoming, with friendly staff offering free samples. This created an experience, not just a transaction. Over 50 years, See's had cultivated a fanatical following. Giving a box of See's Candies for Valentine's Day or Christmas in California was a tradition, a ritual. The brand was associated with quality, nostalgia, and affection. This customer devotion gave See's a phenomenal economic power, pricing power. Buffett quickly realized that the customers of See's were not particularly price-sensitive. When the cost of cocoa or sugar went up, See's could raise the price of its candy, and people would grumble for a moment, and then they would pay it. They wouldn't switch to a cheaper generic brand for a special occasion, because the emotional value of the See's box far outweighed the small difference in price. This is what Buffett would later describe as a moat, a durable competitive advantage that protects a business from competitors. The See's moat wasn't a patent or a government license. It was a deep, emotional connection with its customers forged over half a century of obsession with quality and experience. This customer obsession manifested in every decision. They resisted the temptation to expand too quickly, fearing it would dilute the brand and compromise quality control. They refused to cheapen their ingredients to boost quarterly profits. They maintained their spotless stores and friendly service standards with religious zeal. The culture was entirely oriented around delighting the customer, not just satisfying them. Over the next few decades, See's Candies would generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all without requiring significant additional capital investment. It was an absolute geyser of cash. The initial $25 million investment taught Buffett one of the most important lessons of his career. A business with a culture of true customer obsession possesses an economic asset more valuable and more durable than any factory or patent. It was a lesson that fundamentally shifted his portfolio strategy from buying fair companies at wonderful prices to buying wonderful companies at fair prices. And wonderful, he learned, almost always meant a company that its customers truly loved. The psychological engine behind the success of See's Candies is a powerful combination of behavioral principles that, when harnessed by a company culture, create an almost unbreakable bond with the consumer. At its core is the concept of customer lifetime value, or CLV. Most companies are transaction-focused. They think about the profit from a single sale. A customer-obsessed culture is relationship-focused. They think about the total profit a customer will generate over their entire lifetime of patronage. This long-term perspective, a key tenet of sound wealth management, changes everything. One of the key psychological levers at play is reciprocity. When See's offers a free sample, it's not just a marketing gimmick. It triggers a deep-seated human instinct to reciprocate a gift. Even if you don't buy anything that day, a small seed of positive feeling and obligation has been planted. This principle extends to the entire customer experience. When a company goes above and beyond, offering a generous return policy, providing exceptional support, or consistently delivering a high-quality product, it creates a feeling of indebtedness in the customer. They feel compelled to repay the company with their loyalty and, even more powerfully, with their advocacy. This transforms customers into a volunteer marketing force, a phenomenon known as social proof. When we see our friends, family, and community consistently choosing a particular brand, our brains take a shortcut. We assume it must be good, reducing our own cognitive load and making the purchase decision easier. See's Candies didn't need massive advertising budgets because generations of Californians did the advertising for them. Another crucial principle is what Nobel laureate Daniel Kahneman calls the peak end rule. Our memory of an experience is not an average of every moment. Instead, we disproportionately remember two things: the most intense point, the peak, and the very end. Customer-obsessed companies intuitively understand this. They orchestrate the customer journey to create positive peaks, the delight of a perfect product, a surprisingly helpful employee, and to ensure the end of the interaction is smooth and positive. Think of the seamless one-click checkout process at Amazon, or the friendly farewell from a well-trained employee. By mastering these key moments, they architect a positive memory of the brand, ensuring repeat business. Finally, a culture of customer obsession acts as a powerful defense against the psychological pain of price increases. When a brand is deeply trusted and associated with powerful positive emotions and traditions, it becomes part of a customer's identity. The decision to purchase is no longer purely rational or economic. Switching to a cheaper brand would feel like a downgrade, a small betrayal of a personal standard. This creates what economists call price inelasticity of demand. The company can raise prices without a corresponding drop in sales volume, leading to expanding profit margins. This is the financial holy grail that every CEO and entrepreneur strives for, and it is almost exclusively the domain of companies that have made delighting the customer the central pillar of their entire corporate culture. How can you, as a diligent retail investor, identify a culture of true customer obsession? This requires moving beyond a superficial financial analysis and becoming a student of the customer experience. Here is your blueprint for spotting this powerful competitive advantage. First, you must weaponize customer reviews. Go to Amazon, Yelp, Google, and industry-specific forums. Do not just look at the average star rating. That's for amateurs. Read the one-star reviews and the five-star reviews. In the five-star reviews, look for the why. Are customers just saying it works? Or are they telling detailed emotional stories about how the product changed their life, or how an employee saved the day? The latter is a sign of a deep connection. In the one-star reviews, look for the company's response. Do they ignore the criticism? Do they give canned, corporate-speak apologies? Or do they respond personally, solve the problem, and try to win the customer back? A company that actively and constructively engages with its harshest critics is a company that is obsessed with getting it right. Second, become a product expert. If possible, become a customer yourself. Experience the product or service firsthand. Call their customer support line with a question. How long does it take to get a human on the phone? Is the representative empowered to solve your problem, or are they reading from a script and escalating everything to a manager? The quality of a company's customer service is a direct reflection of its culture. It reveals how much the company values its customers, time, and how much it trusts its own employees. This first-hand investment research is invaluable. Third, analyze the company's language and metrics. Read their annual reports and listen to their conference calls. How do they talk about their customers? Do they use words like users, monetization, and eyeballs? Or do they talk about members, guests, and community? The language they use reveals their mindset. Look for metrics beyond revenue and profit. Do they prominently feature their Net Promoter Score, NPS, a measure of customer loyalty? Do they talk about customer retention rates or repeat purchase volume? Companies that obsess over these metrics are companies that understand that a happy customer is their most valuable asset. The CEO mindset is one that prioritizes these leading indicators of future financial success. Fourth, study their marketing. Is their advertising focused solely on price and features? Or is it focused on the brand's story, values, and the emotional benefit to the customer? Customer-obsessed companies often sell a feeling or an identity, not just a product. Think of Nike's "Just Do It" or Apple's "Think Different." They built tribes, not just customer lists. This brand-focused marketing is a sign of long-term thinking and a deep understanding of the psychology of loyalty, a critical component of any sound long-term investing thesis. By following this investigative process, you are doing the kind of qualitative analysis that Wall Street analysts, chained to their spreadsheets, often miss. You are identifying the companies that are building an unbreakable moat around their business, one happy customer at a time. To truly appreciate the power of customer obsession, we must examine its antithesis, the culture of customer indifference, or worse, customer exploitation. This is the path taken by countless companies that enjoyed temporary dominance only to be disrupted or to slowly bleed out their relevance. The classic examples are the legacy airline and cable television industries of the 20th century. For decades, these companies operated in environments with limited competition, either through regulation or high barriers to entry. This bred a culture of complacency and arrogance. Instead of focusing on delighting the customer, their cultures became focused on extracting as much revenue as possible from a captive audience. This led to what has been called the fee-for-all business model. Airlines began unbundling their services, charging extra for checked bags, seat selection, and even snacks that were once included. Cable companies became notorious for their complex contracts, introductory teaser rates that would skyrocket after a year, and abysmal customer service that involved navigating phone trees and waiting on hold for hours. The psychological principle at play was short-term optimization at the expense of long-term relationships. Every decision was made to boost the next quarter's revenue, with no regard for the slow, corrosive damage being done to the brand. This culture of indifference created a massive reservoir of customer resentment. People didn't do business with these companies because they wanted to. They did business with them because they had to. They were customers, but they were not loyal. This left them incredibly vulnerable. When new, customer-focused competitors emerged, like Southwest Airlines with its transparent pricing and friendly service, or streaming services like Netflix with their simple on-demand model, customers fled in droves. They didn't just leave. They left with glee, finally able to escape a relationship they had long despised. The old guard was forced into a painful and expensive process of trying to reinvent their cultures and rebuild trust, a process that is far more difficult than building it correctly from the start. The lesson for investors is profound. A company that consistently angers or frustrates its customers has a hidden liability on its balance sheet. That liability is a massive, pent-up demand for an alternative. When that alternative appears, the company's market share can evaporate with shocking speed. Any stock analysis that ignores customer satisfaction scores and brand reputation is fundamentally flawed. It's like admiring the beautiful paint job on a car while ignoring the fact that the engine is filled with rust. This is a critical insight for anyone serious about beating the market and achieving superior portfolio growth. The financial link between a culture of customer obsession and superior returns is direct and undeniable. It is the engine that drives sustainable capital gains and creates a true, durable competitive advantage. Let's break down exactly how this soft cultural trait translates into hard numbers on the financial statements. First, pricing power. As we saw with See's Candies, beloved brands can command premium prices. A customer-obsessed company can consistently raise prices at or above the rate of inflation without losing significant business. This flows directly to the top line as increased revenue, and because the costs don't necessarily increase at the same rate, it leads to expanding gross profit margins. Over decades, this is a powerful driver of earnings growth. A company trapped in a price war with competitors will see its margins constantly squeezed, while a company with pricing power will see them consistently grow. Second, lower customer acquisition cost, CAC. A company with happy, loyal customers benefits from the most effective and cheapest form of marketing, word of mouth. A recommendation from a trusted friend is infinitely more powerful than a banner ad or a television commercial. This means customer-obsessed companies can grow their revenue while spending a smaller percentage of that revenue on sales and marketing. This operational leverage is a sign of a highly efficient business model. As revenue increases, the savings on marketing costs fall directly to the bottom line, boosting net income. Third, higher customer lifetime value, CLV. Loyal customers buy more often, and for longer. A customer who stays with a business for 10 years instead of 2 is vastly more profitable. This creates a predictable, recurring revenue stream that is highly prized by investors. It makes forecasting future cash flows easier and reduces the volatility of the business. Companies with high CLV are less susceptible to economic downturns because their established customer base provides a stable foundation of demand. This stability is a key factor in any sound asset allocation strategy. Finally, a culture of customer obsession creates a valuable feedback loop for innovation. Engaged and loyal customers are more likely to provide constructive feedback, suggest new features, and act as beta testers for new products. This provides the company with invaluable, free market research, reducing the risk and cost of new product development. The company can co-create its future products with its most passionate users, ensuring a higher probability of success. This accelerates the company's growth and strengthens its competitive position, making it a prime candidate for any long-term investing portfolio aimed at beating the market. When you see a company with a fanatical customer base, you are not just seeing a popular product, you are seeing a financial machine built for durable, long-term success. Chapter 3: The Innovation Engine. Warren Buffett is famous for his aversion to technology companies, often stating that he prefers to invest in businesses he can easily understand. Yet, one of his greatest investments is a story of profound technological and cultural disruption: Geico. When Berkshire Hathaway took full control of the insurance company in 1996, it was already a successful and profitable enterprise. But it was, at its heart, a traditional insurance company. Its primary method of reaching customers was through direct mail. The culture was solid but conservative. What happened next is a masterclass in how a leader can protect a company's core values while simultaneously fostering a culture of relentless innovation. The man Buffett entrusted to run Geico was Tony Nicely, a company lifer who had started in the mailroom at age 18. Nicely embodied the core Geico culture of efficiency and customer service. But Buffett also gave him the freedom and the capital to experiment, to take calculated risks to propel the business into the future. Instead of resting on their laurels as a direct mail powerhouse, Nicely and his team began to aggressively explore new channels, namely the telephone and the nascent internet. This required a massive shift in mindset and a huge investment in technology and marketing. The most visible result of this cultural shift was a small, green, computer-generated gecko with a British accent. In 1999, the Geico Gecko was born. At the time, insurance advertising was staid, serious, and focused on trust and reliability. A talking lizard was a radical, almost absurd departure. Many corporate cultures would have killed such an idea in committee. It was risky, it was off-brand, it was weird. But the culture Buffett and Nicely had cultivated was one that gave smart people the room to try smart things, even if they seemed unconventional. They tested the concept, the data was promising, and they went all in. The gecko became a cultural phenomenon, an advertising icon that made Geico a household name. This was just the beginning. The culture of innovation continued to push boundaries. They invested heavily in their website and mobile app, making it easier than ever to get a quote and manage a policy. They used data analytics to refine their underwriting and pricing with a precision their competitors couldn't match. They experimented with other humorous ad campaigns, like the Cavemen and Maxwell the Pig, creating a portfolio of marketing assets that dominated the airwaves. The result? From 1995 to 2020, Geico's market share in the U.S. auto insurance industry grew from 2.5% to over 13%. It became the second largest auto insurer in the country, and its underwriting profits for Berkshire Hathaway became immense. This wasn't just a story of a clever ad campaign. It was the story of a culture that was empowered to challenge its own assumptions, to experiment, to risk failure, and to relentlessly innovate its way to market domination. Buffett didn't need to understand the code behind the website. He needed to understand the culture that allowed the website to be built, tested, and constantly improved. That was the real durable competitive advantage. The foundational principle that allows a company like Geico to evolve from a direct mail company into a tech and marketing juggernaut is a concept known as psychological safety. Coined by Harvard Business School professor Amy Edmondson, psychological safety is a shared belief held by members of a team that the team is safe for interpersonal risk-taking. In a psychologically safe environment, employees feel comfortable expressing their ideas, asking questions, raising concerns, and admitting mistakes without fear of being shamed, reprimanded, or fired. It is the single most important ingredient for creating a culture of innovation. On a neurological level, a lack of psychological safety triggers a threat response in our brains. When we fear public failure or ridicule from a superior, our amygdala, the brain's alarm center, goes into overdrive. This floods our system with cortisol and adrenaline, activating our fight, flight, or freeze instinct. This state is incredibly effective for escaping a predator on the savannah, but it is catastrophic for creative problem-solving. It shuts down the prefrontal cortex, the part of our brain responsible for executive functions like complex thought, long-term planning, and creativity. In short, fear makes us stupid. An employee who is afraid of their boss is an employee who will never suggest a radical new idea like the Geico gecko. Conversely, a culture high in psychological safety creates a state of cognitive ease. It lowers the social stakes of experimentation. When a leader explicitly states that failure is an acceptable, even necessary part of the innovation process, it gives employees permission to think. It decouples the outcome of a project from an individual's self-worth or job security. This encourages what is known as intelligent failure, failures that happen quickly, on a small scale, and produce valuable learning that can be applied to the next attempt. This is the essence of the scientific method applied to business. You form a hypothesis, e.g., a talking gecko will sell insurance. You run an experiment, a test ad campaign. You analyze the data, and you iterate. A culture of psychological safety also dismantles the sunk cost fallacy, a powerful cognitive bias that cripples innovation in many large organizations. The sunk cost fallacy is our tendency to continue with a project or investment simply because we have already invested significant time, money, or effort into it, even when it's clear the project is failing. In a fear-based culture, nobody wants to be the person who pulls the plug on a multi-million-dollar project associated with a powerful executive. It's career suicide, so they continue to throw good money after bad. In a psychologically safe culture, an employee can raise their hand and say, "The data shows this isn't working, and we need to pivot or stop," without fear of retribution. This ability to cut losses quickly and redeploy capital to more promising ventures is a massive financial advantage and a hallmark of a dynamic learning organization. This is a core part of the CEO mindset that separates thriving companies from stagnant ones. As an investor, how do you detect the presence of this invisible but vital cultural attribute? How do you perform a stock analysis for psychological safety and innovative capacity? It requires looking for signals that indicate a company is built for learning and adaptation. Here is your blueprint. First, analyze how the company talks about failure. Read interviews with the CEO and other senior leaders. Do they only talk about their successes? Or do they openly discuss projects that didn't work out and, crucially, what they learned from them? A leader who is transparent about failure is a leader who is building a culture where it's safe to fail. Amazon is a famous example. Jeff Bezos often talked about the billions of dollars lost on failures like the Fire Phone, framing them not as disasters, but as necessary tuition paid for innovation. Look for this permission to fail narrative. Second, examine the company's innovation pipeline and history. Are they a one-hit wonder, or do they have a track record of successfully launching new products, services, or business lines over many years? A steady stream of innovation suggests a repeatable process and a deeply ingrained culture, not just a single stroke of luck. Look at their research and development R&D spending. Is it consistent and framed as a long-term investment in the company's future? Or is it the first thing to be cut when the company needs to meet quarterly earnings expectations? The latter is a giant red flag, signaling that the culture prioritizes short-term results over long-term survival. This is a crucial element of any serious investment research. Third, investigate the company's structure and processes. Innovative companies are often decentralized. They push decision-making authority down to small, autonomous teams that are close to the customer. This structure increases speed and agility. Look for evidence of things like 20% time, a policy famously used by Google, where engineers were encouraged to spend 20% of their time on side projects they were passionate about. This is a structural commitment to bottom-up innovation. Read about their product development process. Is it a rigid, top-down waterfall process with dozens of sign-offs? Or is it an agile, iterative process based on rapid prototyping and customer feedback? The process reveals the culture. Fourth, dig into the employee perspective. Once again, employee reviews are a goldmine. Look for mentions of words like bureaucracy, red tape, and politics. These are the enemies of innovation. Conversely, look for praise of autonomy, collaboration, and empowerment. Pay attention to stories about how new ideas are treated. Are they embraced and explored, or are they shot down by middle management? This qualitative data provides a window into the daily reality of the company's innovation engine, or lack thereof. This deep dive is what separates a casual stock-picking approach from a professional portfolio strategy. The antithesis of the innovative culture is the culture of complacency and incumbency. This is the tragic story of companies that once dominated their industries but failed to adapt to a changing world, not because of a lack of resources or talent, but because their own culture prevented them from seeing the future. The quintessential example is Eastman Kodak. For most of the 20th century, Kodak was not just a company, it was photography. It had a near monopoly on the film business, a tremendously profitable empire built on its razor and blades model. Sell the cameras cheap and make a fortune selling the consumable film. The irony is that Kodak was not blind to the future. In 1975, a Kodak engineer named Steven Sasson invented the world's first digital camera. It was a clunky device, the size of a toaster, but it worked. He presented his invention to Kodak's management. Their reaction is a chilling lesson in cultural dysfunction. According to Sasson, they said, "That's cute, but don't tell anyone about it." Why? Because digital photography fundamentally threatened their cash cow, the film business. The company's entire identity, its manufacturing processes, its profit formula, and its power structure were all built around chemical-based film. The culture was optimized to protect the existing business, not to create a new one. This is a psychological phenomenon known as commitment and consistency bias on an organizational scale. The company was so deeply committed to its past success that it was psychologically incapable of embracing a new and disruptive model. Any manager who championed digital photography was seen as a threat to the established order. The incentive structure was entirely skewed towards maximizing film profits in the short term. They suffered from a catastrophic failure of imagination, driven by a culture of risk aversion and a fear of cannibalizing their own products. While Kodak sat on the technology, companies like Sony, Canon, and later Apple with the iPhone embraced the digital revolution and ate Kodak's lunch. By 2012, the company that had once defined photography was forced to declare bankruptcy. Kodak didn't fail because it lacked the technology. It failed because it lacked a culture that could embrace it. This serves as a stark warning for any entrepreneur or investor. A successful past is no guarantee of a successful future if the culture is not built to innovate. The financial impact of a culture of innovation is nothing short of explosive, and it is the primary driver of long-term growth for many of the world's most valuable companies. Understanding how this translates to financial statements is critical for identifying businesses capable of generating massive capital gains. First, an innovative culture drives sustained, high-margin revenue growth. Companies that consistently create new products or enter new markets can continue to grow long after their original core business has matured. Think of Apple. It started with computers, then reinvented the music industry with the iPod and iTunes, the phone industry with the iPhone, and created new categories with the iPad and Apple Watch. Each new innovation created a fresh wave of revenue growth, often at very high profit margins. This is in stark contrast to a company with a single successful product, which will eventually face market saturation and commoditization. Second, innovation is the ultimate defense against disruption. In today's fast-changing world, no competitive advantage is safe forever. A company that is constantly innovating is a moving target. It is disrupting itself before a competitor can do it. This creates resilience and longevity. From a financial perspective, this reduces the risk premium an investor should demand for holding the stock. A company that is built to adapt is simply a less risky long-term investment, which should, in theory, command a higher valuation multiple, like a higher PE ratio. Third, successful innovation creates valuable intellectual property, IP. Patents, trademarks, and proprietary technology show up on the balance sheet as intangible assets. In the modern economy, these intangible assets are often far more valuable than a company's physical factories and equipment. A strong portfolio of IP can create a powerful moat, locking out competitors and generating high-margin licensing revenue. This directly increases the book value and intrinsic value of the business. Finally, a culture of innovation attracts and retains the best talent. The most creative and driven engineers, designers, and marketers want to work in an environment where they can do their best work and make an impact. This creates a virtuous cycle. A great culture attracts great people, who in turn do great work that strengthens the business, which allows the company to invest even more in its culture. This talent arbitrage is a hidden asset that pays dividends for decades. A company that is known as the best place to work in its industry has a sustainable advantage in the war for talent, which is, in the knowledge economy, the only war that matters. This is a foundational concept for any asset allocation strategy focused on durable, long-term growth. Chapter 4: The Stewardship Mindset. The ultimate foundational anecdote for a culture of long-term stewardship isn't a single transaction Warren Buffett made. It's the entire structure and philosophy of his creation, Berkshire Hathaway. Berkshire is not a normal corporation. It is a holding company with a tiny headquarters in Omaha, Nebraska, staffed by just a couple dozen people. Yet, it owns and controls a vast empire of diverse businesses, from insurance and railroads to candy and jewelry. The key to understanding its success lies in the unique culture of stewardship that Buffett has meticulously cultivated over more than half a century. When Berkshire acquires a company, it is almost always a business with a long history of success, often one that is still run by its founding family. Buffett's pitch to these owners is unique. He is not a typical corporate raider or a private equity fund looking to strip assets, load the company with debt, and flip it for a quick profit. His promise is permanence. He tells them, "We will be your final home. You built this business over a lifetime. We will protect it for generations to come." He buys businesses to keep them forever. This simple promise changes the entire dynamic of the acquisition. Once a company is part of the Berkshire family, the culture of stewardship truly reveals itself. Buffett and Munger practice a radical form of decentralization. The CEOs of the subsidiary companies are left almost entirely alone to run their businesses as they see fit. There are no weekly meetings with headquarters, no endless PowerPoint presentations to justify their decisions. They are trusted completely, as long as they adhere to two simple rules. First, guard Berkshire's reputation with your life, and second, report any bad news immediately. The compensation for these CEOs is not tied to Berkshire's overall stock price, but to the long-term performance of the specific business they manage. This fosters a sense of true ownership. They are not just managing a division, they are stewarding a legacy. Consider the acquisition of the BNSF Railway in 2009. This was a massive, capital-intensive business, the lifeblood of the American economy. Buffett didn't buy it to squeeze a few extra points of margin out of it next quarter. He bought it as a permanent bet on the long-term prosperity of the United States. He knew that to thrive for the next 100 years, the railroad would need continuous, massive investment in its tracks, locomotives, and technology. A typical Wall Street-driven company might be tempted to skimp on this long-term capital expenditure to boost short-term earnings per share. But under Berkshire's stewardship culture, the CEO of BNSF is empowered and encouraged to make the necessary investments for the next century, not the next quarter. This is the stewardship mindset in action. It is a culture built on trust, autonomy, and an almost infinite time horizon. It is the secret sauce that has allowed Berkshire to compound capital at a rate that has baffled the financial world for decades. The psychological principle that a stewardship culture is designed to combat is one of the most powerful and pervasive cognitive biases we face: hyperbolic discounting, also known as present bias. This is our brain's innate tendency to value a smaller, immediate reward more highly than a larger, future reward. It's the reason we choose to eat a slice of cake today instead of sticking to a diet for the long-term benefit of better health. It's the reason we spend money on an impulse buy instead of investing it for our retirement. In the corporate world, this bias is amplified by the relentless pressure of the quarterly earnings cycle. A CEO of a publicly traded company knows that if they miss Wall Street's earnings expectations for a single quarter, their stock price can be punished severely. This creates an overwhelming incentive to prioritize short-term results. They might cut the R&D budget, delay necessary maintenance on equipment, or reduce customer service staff, all moves that will boost profits this quarter but will damage the company's long-term health. They are choosing the small, immediate reward, a good quarterly report, over the larger, future reward, a durable, thriving business. This is hyperbolic discounting at a corporate scale, and it is a disease that rots companies from the inside out. A stewardship culture acts as a powerful antidote to this bias. It does so by fundamentally changing the time horizon of decision-making. When a CEO is told that their primary job is to ensure the business is stronger in 10, 20, or even 50 years, it liberates them from the tyranny of the next 90 days. This shift to an infinite time horizon changes the calculus of every major decision. An investment in employee training is no longer an expense, it's a long-term asset. Building a new state-of-the-art factory is no longer a drag on short-term return on capital. It's a foundation for decades of efficient production. Choosing to walk away from an unethical but profitable sale is no longer a missed opportunity. It's a necessary defense of the company's most valuable asset, its reputation. This long-term focus also cultivates a sense of what psychologists call generativity, the desire to create and nurture things that will outlast the self. Leaders in a stewardship culture see themselves not as mere managers of a set of assets, but as custodians of a legacy. They are planting trees whose shade they may never sit in. This provides a powerful, intrinsic motivation that goes far beyond a quarterly bonus. It taps into a deep human need for purpose and meaning. This is the psychological fuel of the stewardship mindset, a force that allows companies to make decisions that are not just profitable, but wise. This is a core component of a sound wealth management philosophy that extends from personal finance to corporate governance. How can you, as an outside investor, diagnose the presence of a stewardship mindset within a company? It's about looking for the markers of long-term thinking in a world obsessed with the short term. Here is your blueprint for identifying companies that are run by stewards, not mercenaries. First, and most importantly, dissect the executive compensation plan. This is where a company's true priorities are revealed. Is the CEO's bonus tied to short-term metrics like quarterly revenue growth or earnings per share, EPS? These metrics can be easily manipulated and encourage short-sighted behavior. Or is compensation tied to long-term value creation? Look for plans that use metrics like 3 to 5 year growth in return on invested capital, ROIC, growth in intrinsic business value, or restricted stock grants that don't vest for many years. A compensation plan that rewards sustainable long-term performance is the clearest sign you can find of a board of directors that is serious about stewardship. Second, analyze the company's capital allocation decisions over the last decade. This is the most important job of any CEO. Where are they putting the company's cash? Are they consistently investing in their core business through intelligent capital expenditures and R&D? Are they making smart strategic acquisitions that fit with their long-term vision? Or are they engaging in value-destructive behaviors, like making overpriced acquisitions just to grow the size of their empire? Or buying back their own stock at inflated prices simply to boost short-term EPS? A track record of patient, disciplined, and value-creating capital allocation is the hallmark of a true steward. This deep dive into capital allocation is a cornerstone of advanced stock analysis. Third, read the CEO's shareholder letter as if it were a sacred text. Pay close attention to the time frame they use. Are they constantly talking about this quarter and next quarter? Or are they framing their strategy in terms of years and decades? Do they talk about building something enduring? Do they speak about their employees, customers, and communities as partners in a long-term journey? Warren Buffett's letters are the gold standard. He writes to his shareholders as if they were business partners, explaining his decisions with clarity and a focus on the long-term horizon. Look for that same spirit of partnership and long-term orientation. Fourth, investigate the company's balance sheet. A stewardship culture inherently values financial prudence and resilience. Stewards don't like to take on excessive debt, as it can put the company at risk during an unexpected downturn. They prefer to maintain a, quote, fortress balance sheet with plenty of cash and low leverage. This financial conservatism might mean slightly lower returns during boom times, but it ensures the company can not only survive, but thrive during recessions, often by acquiring weaker competitors at bargain prices. A strong balance sheet is a physical manifestation of a long-term mindset, a critical factor for any retail investor building a durable portfolio. The antithesis of the stewardship mindset is the culture of short-termism, often exemplified by the slash-and-burn tactics of certain activist investors or the quarterly earnings game played by many public companies. This culture is not focused on building a great business, but on hitting a number. The narrative is dominated by the next 90 days. A classic, though controversial example, is the story of Chainsaw Al Dunlap and his tenure at Scott Paper in the mid-1990s. Dunlap was a celebrity CEO, a corporate turnaround artist who was brought in to boost the struggling paper company's stock price. His philosophy was simple and brutal: cut costs at all costs. Within his first year, he laid off over 11,000 employees, about a third of the workforce. He closed factories, sold off business lines, and eliminated the company's R&D budget. He moved the corporate headquarters just to get a tax break. The culture he instilled was one of pure fear and survival. The focus was entirely on making the company look as profitable as possible, as quickly as possible, to prepare it for a sale. In the short term, his methods worked like a charm. The stock price of Scott Paper tripled in less than 2 years. Wall Street analysts and financial journalists hailed him as a hero, a tough-as-nails manager who was creating shareholder value. He was celebrated on the covers of magazines. But what was he actually creating? He wasn't building a better business. He was harvesting it. He was cutting out the muscle and bone of the company, its experienced employees, its capacity for innovation, its community ties, to make the next quarter's financials look good. He sold the hollowed-out company to Kimberly-Clark for a huge premium, making a personal fortune of $100 million for 20 months of work. This is the ultimate expression of a non-stewardship culture. It treats a company not as a living organism to be nurtured, but as an inanimate object to be bought, stripped for parts, and sold. It prioritizes the immediate financial gain of a few shareholders and executives over the long-term health of the institution and the well-being of its employees, customers, and communities. While Dunlap's tactics produced a short-term spike in the stock price, they destroyed the company's soul and its potential for future growth. For long-term investors, this kind of culture is poison. It may provide a temporary sugar high, but it inevitably leads to a crash. Identifying and avoiding these harvester cultures is just as important as identifying steward cultures. This is a key secret for beating the market over time. The direct financial connection between a stewardship mindset and long-term investment returns is the most powerful force in finance, the magic of compounding. A company run by stewards is a company built to compound its intrinsic value over decades, creating a cascade of positive financial outcomes for its shareholders. First, consider the impact on return on invested capital, ROIC. Stewards are obsessed with allocating capital only to projects that they believe will generate a high return over the long run. They are patient. They will hold cash and wait for the right opportunity rather than chase mediocre investments just to show activity. This discipline leads to a consistently higher ROIC than their short-term focused peers. A company that can consistently generate an ROIC of, say, 15% will grow its intrinsic value far faster than a company that generates a scattershot 8%. This is the primary engine of long-term value creation. Second, a stewardship culture leads to greater financial stability and lower risk. By avoiding excessive debt and maintaining a strong balance sheet, these companies are better equipped to weather economic storms. They don't face existential risk during a credit crunch. This resilience means they are less likely to permanently impair shareholder capital by being forced to issue dilutive equity or sell assets at fire sale prices during a downturn. This survival premium is an underappreciated source of long-term outperformance. Third, this long-term focus allows for the creation of deeper, more durable competitive advantages. Building a beloved brand, developing a culture of innovation, or creating a uniquely efficient supply chain takes years, even decades, of consistent investment. A steward-led company is willing to make these long-term investments, even if they depress earnings in the short run. This widens the company's economic moat, protecting its profitability for many years to come. This directly translates into more predictable and sustainable future cash flows, which is the definition of a high-quality business. Finally, the effect on shareholder returns can be staggering. Imagine two companies. Company A is focused on the short term, growing its earnings by 10% a year, but doing so by taking on debt and underinvesting in its future. Its stock price might do well for a while. Company B is a steward, growing its intrinsic value by a more modest 8% a year, but doing so sustainably and consistently, with a strong balance sheet and continuous investment. Over 5 years, Company A might look better, but over 20 or 30 years, the power of consistent, high-quality compounding will make Company B exponentially more valuable. A stewardship culture is not just a moral or ethical choice. It is the most rational and effective financial strategy for generating extraordinary long-term capital gains. It is the very essence of the Warren Buffett approach to investing. Chapter 5: The Anti-Bureaucracy Immune System. Our final anecdote comes from a company that Warren Buffett's partner Charlie Munger has served on the board of for decades, and one that Buffett deeply admires: Costco Wholesale. Costco is a retail giant, a behemoth with hundreds of warehouses and tens of millions of members worldwide. By all conventional business logic, a company of its size and scale should be a slow-moving, complex bureaucracy. Yet, it remains one of the most nimble, efficient, and fanatically focused organizations on the planet. This is because its culture was designed from day one to be a powerful immune system against the disease of corporate bloat. The Costco culture is built on a few simple, non-negotiable rules. First, a militant commitment to low prices. The company has a strict cap on its markups. No branded item can be marked up by more than 14%, and no private label item by more than 15%. Most retailers would see rising costs as an opportunity to raise prices and expand their margins. Costco sees it as a challenge to become even more efficient, to find ways to cut its own costs to avoid passing them on to the customer. This relentless focus on efficiency is the first line of defense against bureaucracy, because bureaucracy is, by its nature, expensive and inefficient. Second, an obsession with simplicity. A typical Costco warehouse carries only about 4,000 different products, compared to the 40,000 or more you might find in a typical supermarket. This radical simplification has profound effects. It gives Costco immense buying power with its suppliers. It simplifies inventory management. It makes the shopping experience faster and less overwhelming for the customer. The culture actively resists the temptation to add complexity. If a new initiative, a new layer of management, or a new report doesn't clearly add value to the member or reduce costs, it is ruthlessly rejected. Third, a deep trust in its employees. Costco pays its frontline workers significantly more than the retail average and provides excellent benefits. This isn't charity, it's a core business strategy. Well-paid, happy employees are more productive, provide better customer service, and are far less likely to leave. This dramatically reduces turnover and its associated costs. More importantly, it creates a culture of ownership. The organizational structure is famously flat. Warehouse managers have enormous autonomy. The company trusts its people on the ground to make the right decisions, eliminating the need for layers of micromanaging bureaucrats at corporate headquarters. The story of Costco's founder, Jim Sinegal, personally answering his own office phone is legendary. It was a symbol of a culture that valued directness, accessibility, and a hatred of corporate pretense. This anti-bureaucratic immune system is Costco's most powerful and most difficult to copy competitive advantage. The psychological principles that explain why Costco's culture is so effective are rooted in the cognitive limitations of the human brain and the social dynamics of groups. As organizations grow, they naturally bump up against two powerful forces: Parkinson's law and the Dunbar number. Parkinson's law is the old adage, first articulated by Cyril Northcote Parkinson, that, quote, work expands so as to fill the time available for its completion. In a corporate context, this means that departments and managers have a natural incentive to expand their headcount and budget, not necessarily because there is more work to be done, but because a larger team and a bigger budget are symbols of power and importance. This creates a self-perpetuating cycle of bureaucratic bloat. The Dunbar number, proposed by anthropologist Robin Dunbar, suggests that there is a cognitive limit to the number of people with whom one can maintain stable social relationships. That number is around 150. Once an organization or a single location grows beyond this number, communication starts to break down. People no longer know everyone personally. Trust erodes, and formal rules, processes, and hierarchies must be implemented to manage the complexity. This is the birth of bureaucracy. A strong, decentralized, anti-bureaucratic culture like Costco's acts as an immune system to fight these natural tendencies. It does this by aligning the entire organization around a simple, clear, and compelling mission: provide the highest quality goods at the lowest possible prices. This mission acts as a filter for every decision. When a manager considers adding a new process or hiring a new person, the question is not, will this increase my influence? But will this help us lower prices for the member? This shared purpose overrides the personal incentives that drive bureaucratic expansion. Furthermore, by keeping the organizational structure flat and giving significant autonomy to individual warehouse managers, Costco keeps its operating units closer to the scale of the Dunbar number. A warehouse manager and their team form a cohesive unit with a clear leader and a shared goal. They are not bogged down by directives from a distant, disconnected headquarters. They are empowered to solve their own problems, This taps into the psychological need for autonomy and mastery, leading to higher job satisfaction and better performance. The culture essentially creates a federation of small, entrepreneurial teams operating under a single powerful brand and mission. This structure allows the company to achieve massive scale without succumbing to the slowness, inefficiency, and political infighting that cripples most large organizations. It's a brilliant solution to the inherent psychological challenges of organizational growth. How can you, as an investor, spot a company with a strong anti-bureaucratic immune system? You must look for the signs of simplicity, speed, and employee empowerment. This is the final blueprint for your qualitative analysis toolkit. First, study the organizational chart and leadership structure. Is it a tall, complex pyramid with dozens of layers between the CEO and the frontline employee? Or is it a relatively flat structure? Look for titles. A proliferation of senior executive vice presidents of global strategic synergy is a red flag. A simple structure with clear lines of responsibility is a sign of a culture that values action over administration. Analyze the size of the corporate headquarters staff relative to the total number of employees. A lean headquarters like Berkshire Hathaway's or Costco's is a powerful indicator of a decentralized, anti-bureaucratic culture. Second, assess the company's speed of execution. How quickly do they bring new products to market? How fast do they expand into new geographies? Bureaucracies are slow. They are bogged down in meetings, committees, and approval processes. Nimble, decentralized companies can move with incredible speed. Read business articles and case studies about the company. Do they have a reputation for being agile and decisive, or for being a lumbering giant? This is a critical factor in a fast-moving economy. Third, look for evidence of a relentless focus on efficiency. Does the company talk about its cost structure as a competitive weapon? Read about their operational processes. Are they known for innovations in logistics, manufacturing, or supply chain management? A company that is obsessed with wringing out every penny of unnecessary cost is a company that is inherently hostile to the waste and redundancy of bureaucracy. This operational excellence is a key part of any in-depth stock analysis for entrepreneurs and investors alike. Fourth, and finally, listen to the language of the employees. Employee reviews are, once again, your secret weapon. Search for keywords like red tape, politics, meetings, and slow. An abundance of these terms is a clear sign that bureaucracy is choking the life out of the company. On the other hand, look for praise of autonomy, ownership, fast-paced, and empowerment. When employees feel like they can get things done without having to navigate a maze of corporate approvals, you have found a company with a strong immune system. This is the kind of organization that is built to win over the long term. The antithesis of Costco's lean and focused culture is the cautionary tale of the bloated, inward-looking bureaucracy. The classic case study is General Motors in the latter half of the 20th century. For decades, GM was the largest and most powerful corporation in the world. Its market share in the U.S. was over 50%. This dominance bred a culture of arrogance and complacency. The company became a massive, labyrinthine bureaucracy, famous for its stifling committee-based decision-making. The culture at GM was famously insular. Executives at the Detroit headquarters were disconnected from the realities of the market and the needs of their customers. Decisions were made based on internal politics and divisional turf wars, not on building the best cars. The company was organized into competing divisions: Chevrolet, Pontiac, Oldsmobile, Buick, Cadillac, that often produced nearly identical cars, creating massive internal redundancy and customer confusion. The focus was on protecting the status quo, not on innovation. When Japanese automakers like Toyota and Honda entered the market with smaller, more reliable, and more fuel-efficient cars, GM's bureaucratic culture was too slow and too arrogant to respond effectively. Stories from that era are legendary. It could take years for a new car design to go from concept to production, winding its way through endless committees. The finance department held immense power, often overriding engineers and designers to save a few pennies per car, resulting in lower quality and a tarnished brand reputation. The company was so complex that it was said that no single person truly understood how it all worked. This is the end state of unchecked bureaucracy, a slow, confused, inefficient, and inward-looking organization that is incredibly vulnerable to more focused and agile competitors. Eventually, decades of this cultural rot culminated in GM's historic bankruptcy in 2009. It was a stunning fall from grace, a direct result of a culture that had lost its immune system and allowed bureaucracy to consume it from within. The direct financial connection between an anti-bureaucratic culture and financial performance is all about operational efficiency and asset productivity. A lean, fast-moving organization can do more with less, which translates into superior profitability and returns on capital. First, look at the selling, general, and administrative (SG&A) expenses on the income statement. This line item includes all the non-production costs of running a business, like corporate salaries, marketing, and office overhead. Bureaucracies have bloated SG&A expenses due to their layers of middle management and large corporate staffs. A company with an anti-bureaucratic culture, like Costco, will have a significantly lower SG&A as a percentage of revenue compared to its competitors. This cost advantage allows them to either offer lower prices to gain market share or to enjoy higher profit margins. Either way, it's a direct financial benefit. Second, consider asset turnover. This is a key financial ratio that measures how efficiently a company is using its assets to generate revenue. It's calculated as revenue divided by total assets. A company that is nimble and efficient can generate more revenue from every dollar of assets, be it inventory, factories, or stores. Costco's limited product selection allows it to turn over its entire inventory much faster than a traditional retailer. This high asset turnover means they have less capital tied up in slow-moving inventory, which frees up cash and increases the overall return on assets. Third, an anti-bureaucratic culture leads to better and faster capital allocation decisions. In a bureaucracy, decisions to invest in new projects or enter new markets can be delayed for months or even years by analysis paralysis and political infighting. In a decentralized, empowered culture, these decisions are made more quickly and by the people who are closest to the information. This speed and agility is a massive competitive advantage. It allows the company to seize opportunities before its slower rivals even realize they exist. This ability to deploy capital quickly and intelligently is a huge driver of long-term growth and a key factor in any successful portfolio strategy. Ultimately, a company's culture, its foundation of trust, its obsession with the customer, its engine of innovation, its stewardship mindset, and its anti-bureaucratic immune system is not separate from its financial performance. It is the operating system that produces that performance. It is the hidden asset, the invisible architecture, that determines whether a company will compound its value for decades or slowly crumble under its own weight. Learning to see and analyze this asset is the single most important step you can take in your journey, from being a passive follower of the market to an active and intelligent investor capable of building true, lasting wealth. You have just spent a significant amount of time rewiring your brain. You've moved beyond the two-dimensional world of the spreadsheet and learned to see the three-dimensional reality of a business. You now possess a powerful mental tool, the ability to analyze a company's culture as its most critical and durable competitive advantage. You understand that trust is an economic accelerator, that customer obsession creates pricing power, that psychological safety fuels innovation, that a stewardship mindset drives compounding, and that an anti-bureaucratic immune system ensures longevity. This is no small thing. This is a fundamental shift in how you conduct investment research, a permanent upgrade to your financial analysis toolkit. But it is crucial to understand that this is only one piece of a much larger interconnected system. Warren Buffett's success does not come from a single mental model, but from a latticework, as Charlie Munger calls it, of interlocking models that support and inform one another. You have just mastered a critical part of the map, but it is not the whole map. Knowing how to identify a great culture is essential, but it must be connected to the principles of valuation, the discipline of capital allocation, and the understanding of behavioral finance. The cultural analysis tells you what to buy. The other models tell you when to buy it, and at asterisk what price. The video that is appearing on your screen right now is not an accident. It has been selected by a powerful algorithm that understands your journey. Think of it as the missing link, the next piece of the map. It is the bridge that connects what you have just learned about identifying wonderful businesses to the next critical skill you must acquire. It may be about calculating intrinsic value, understanding float, or mastering the concept of a margin of safety. Whatever it is the link that will connect everything you've learned here into a more powerful, cohesive whole. The question now is, who do you want to be? Are you someone who collects interesting ideas? Or are you someone who is committed to building a complete mental arsenal for financial success? The click you are about to make is not just about watching another video, it is a decision. It is a declaration about your commitment to continuing this ascent, to moving beyond the mindset of a retail investor and adopting the comprehensive worldview of a true capital allocator. The journey is not over. The most important connection is yet to be made. Complete your arsenal. Click the video.